A trader's best friend is a trading plan. Setting up a trading plan is an essential step in forex trading, as it helps traders to define their goals, strategies, and risk management techniques. A well-defined trading plan can help traders to stay focused and disciplined, and to make more informed and profitable trading decisions. Here are some steps to help in setting up a trading plan. Define your goals. Clearly define your financial goals and the reasons why you want to trade in the forex market. This will help you to determine the level of risk you are willing to take and the amount of capital you are willing to invest. Develop a strategy. Choose a trading strategy that best suits your goals, risk tolerance, and trading style. This may include a technical analysis strategy, a fundamental analysis strategy, or a combination of both. Identify entry and exit points. Use technical analysis and chart patterns to identify key levels of support and resistance, and use these levels to determine where to enter and exit trades. Determine risk and reward. Calculate the potential risk and reward for each trade, and use this information to determine the appropriate position size for each trade. Establish a risk management plan. Develop a risk management plan that includes stop-loss and take-profit orders, and use these orders to limit your potential losses and lock in your potential profits. Keep a trading journal. Keep a record of all your trades, including the reasons for entering and exiting the trade, the outcome of the trade, and any lessons learned. This will help you to track your progress and improve your trading performance over time. Review and adjust. Regularly review and adjust your trading plan as needed, based on your results and any changes in market conditions. It is important to remember that a trading plan is a living document and should be reviewed and adjusted regularly to reflect changes in the market and your own personal performance. It's also crucial to have the discipline to stick to the plan even in difficult times. It is also essential and very helpful to keep a trading journal to keep record of everything and have a basis for improvement. A trading journal is a record of all of a trader's trades, including the reasons for entering and exiting the trade, the outcome of the trade, and any lessons learned. Keeping a trading journal is an important tool for tracking progress and improving performance in forex trading. A trading journal can include the following information: trade details, date, time, currency pair, trade direction, long or short, entry and exit prices, stop-loss and take-profit levels, and the outcome of the trade, profit or loss. Reasons for the trade. The trader's analysis and reasoning behind entering the trade, whether it be based on technical or fundamental analysis. Emotions. A trader's emotions and mindset at the time of the trade. It could be helpful to know how you felt in certain situations, so you can avoid or replicate them in the future. Lessons learned. Any lessons learned from the trade, such as mistakes made or successful techniques used. Performance evaluation. A trader's performance can be evaluated by analyzing the trading journal to see which trades were profitable and which were not, and to identify any patterns or trends that may be affecting performance. Risk management. A trader can also track their risk management strategy, for example, how well they adhered to their risk-reward ratio and stop-loss levels. By keeping a trading journal, traders can learn from their past mistakes, identify successful techniques, and make more informed and profitable trading decisions in the future. It also helps to have a clear and honest record of performance, which is essential for self-evaluation and improvement. Thank you for watching. Please don't forget to subscribe to learn more about trading.